Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hi, everyone. Welcome to the RIA Edge podcast. This, as you know, is my chance to speak with executives at RIA firms that are growing, in our estimation, by design, not by default, otherwise not simply wafting up on market appreciation, but rather designing sustainably growing RIA firms, and we think of as the wealth management firms of the future. In this episode, I'm thrilled to be joined by Jim Gold, the CEO of Steward Partners. Jim, thanks very much for joining us.
Oh, it's my pleasure. Thanks for the opportunity.
Jim, I know you did this podcast maybe a couple of years ago, but I thought we could, do a catch-up episode here and find where you are on your growth trajectory. But for the folks who didn't hear that podcast or who maybe are not as familiar with Steward Partners, can you tell us a little bit about the firm, yourself, and where you guys are now in terms of AUM, clients, advisors?
Sure, absolutely. Yeah, so Steward was founded 11 years ago. Myself and my partners are wirehouse breakaways ourselves. So we come up out of the Smith Barney origins from there and really built a firm, I think, with a unique business plan around breakaways and a W-2 model that really says we want to give you the best of both worlds, right? The best parts of being at a major firm without the drawbacks and the best parts of being independent without the drawbacks of that. Fast forward, our 10th full year, our growth actually is accelerating, which is amazing for a firm of our size. So about 40 billion in assets, about 28 of that is in our corporate RIA. Really proud to be recognized by Barron's again last year as the 18th largest RIA in the world. And really, again, I think the story is better than it was last time we spoke, and a lot of good stuff going on at the firm.
Great. So where are you in terms of size now? How many offices around the country?
67-ish, 68 maybe. It goes up every week, thankfully.
Yeah. And that's certainly something we'd like to talk about. It still seems that Steward Partners is very active in the M&A market, and that has not seemed to slow down recently. Can you tell me a little bit about your M&A strategy? And we'll get into some other drivers of growth in a minute, but let's just tackle the M&A side of it first, because I think you're pretty active in that market. What's your philosophy when you approach the M&A market? What are you looking for, and how do you think about that in terms of your growth overall?
Yeah, I think it's, for us, it's a newer part of our story. So our first M&A transaction was consummated about 14 months ago. And we had spent about a year and a half prior to that, sort of building a strategy, thinking about, the whole thing from start to finish, from where are we going to source it? How does it work? How does it look like? How do we do it in a steward manner? I think is how we were trying to think about it. So our strategy really is we look at this as an antidote to what I talk about as the succession crisis in our industry, right? If you look at the Cerulli data, 50% of all advisors today will be retired in 15 years. And if you really think about that, 50% of all wealth management is up for grab, in the next 15 years. So that is, I think, driven by two factors. One is you've had a very healthy market for the last couple of decades. And I think the other part is even better news, which is, listen, people are living longer, advisors are living longer, people are living healthier and longer. So the idea of being an advisor into your 70s is not unheard of. And as a matter of fact, there's more advisors in their 70s today than there are in their 30s in the industry. So that, like everything else, father time is undefeated, as they like to say. So those folks are going to need to figure out a succession plan. And at Steward, we look at our succession model, our legacy channel, really is about facilitating those transactions. It's about not being disruptive to the clients, which is really rare. Mm-hmm. And we love the teams that say, hey, we have the infrastructure, we have a multi-generational team. We just lack the capital and the resources to help the senior partners, monetize and sunset. And we're happy to facilitate that and excited about the opportunity to continue to work with their colleagues who, plan on remaining with us for decades to come.
So the folks that you approach in the M&A market are these multi-generational, multi-advisor teams, larger probably than the average RIA. one of the things that we hear about is this problem with succession is for a lot of these RIAs getting to the point now, they're such a size where the junior partners can't afford to take over the succession of the firm from their senior advisors or the principals. So you're suggesting you step in these sort of situations and can help smooth that transition out.
Correct. Yeah, and I think what people are also missing, and at Steward, when you see teams joining us, it's hard to really see through the announcement and say, is this a recruit or is this M&A? So what
Yeah.
we're seeing is a huge trend towards what I call breakaway M&A, right? Because many of these folks are realizing that if you're going to sell your practice and your life's work, you should at least check the market to see where the valuations are. And in almost every case, the valuations in leaving a wirehouse firm are far greater than staying there. And then it really becomes a question that I ask them is to say, how do you feel about leaving your legacy at your current firm? And many of them say, yeah, I wouldn't be excited about that. So I think it creates another opportunity that with our background and our lineage as a breakaway firm, we've really been able to execute that on a level that other firms have not yet.
Interesting. And when you're looking out there, you difference between a recruit and an acquisition, still the majority of the advisors which join you at Steward Partners are still coming out of the wirehouses, or has that mix has changed?
The mix has changed, and I think we want to be very careful and thoughtful as we're not trying to steer someone in one direction or the other. So if someone engages in conversation with Steward, it's really we say, look, we have an ability to affiliate as a recruit. If you have an interest in learning about monetizing your practice and affiliating that way, we're happy to show you both. These folks tend to self-select, right? They kind of know where they are in that journey. But yeah, so we're very happy and excited that we have dramatically increased our opportunities where we're seeing recruits from numerous independent firms, regional firms. So the spectrum of opportunity at Steward has only continued to grow by channels, by firms, and it's no longer just the big four as our only sort of hunting ground, if you will.
Yeah, sure. And you said this, relatively recent entry into the, pure RIA side of what you're doing. The acquisitions over there on that side, can you talk a little bit about the mechanics of this? I mean, you're employee owned. You still have some PE backers. Equity is part of the mix every time, I'm sure. Can you talk a
Yep.
little bit about the structure of what these partnerships look like?
Yeah, so whether you're a recruit or you're selling as your practice, every transaction has an equity component that is meaningful. It's interesting. Many folks that we engage with say, "Hey, I'd like to get more equity now that I really understand the equity and I understand what you're doing. I realize the value of that, not just today, but the future value and the wealth creation opportunity there, which is very significant." So if you think about our firm, I mean, 5 years ago, we took on our first outside capital. We were around 9 billion in assets, right? So you've seen almost 500% asset growth in the last 5 years. So there's a real track record here of growth. And as you said earlier, we'll talk about the other ways we grow, but inorganic and organic are things we focus a lot of our time on.
Can you talk a little bit about, if we could just stick with M&A for a second, valuations and where you see those going? There was some thought that raising interest rates would bring down valuations, or there'd be a rush to get deals done by the end of the year before, different interest rates picked in, dropped, or, I don't know. You tell me, what's the environment out there for valuations for firms now?
I mean, listen, valuations are very healthy, and as a firm that is owned by our partners here, we like the valuations are healthy. That's good for all of us. But look, I think, and you've all seen the data where there's tiers of valuations, right? So people tend to lock in on the best number out there. So people hear 20x EBITDA. Well, 20x EBITDA, and there was a recent article about this, talks about, that's a firm of $5 billion plus with a real growth record, a track record with a management team, a leadership team. And as you know, the vast preponderance of RIAs are under $500 million. So those folks tend to trade more in the high single digits to low teens. I think our story is unique in the support because a lot of times we'll talk to folks who have joined us and they'll say, well, I have a better offer here, but when I talk to them, they don't have a transition team. They don't have a technology group. They don't have a full compliance department. So there's deliverables that are important to people, especially when they're selling their practice, because what do they care about most? Once you get beyond the money, you care about where you're leaving your legacy. You care about making sure your clients are in a great place. And that's where us being a very non-invasive, non-disruptive option, we let them keep their brand. They can co-brand with us. We're proud to share our brand. They don't have to turn around and change all the way they run money in a year or so and adopt a new firm's models. We embrace saying, hey, listen, you've been successful before you came here. Our only goal is to help you continue to be successful. And telling you to change everything you built is not a good strategy in our mind.
And so a lot of these firms keep their own Form ADVs, or do they come onto your Form ADV?
They come under our ADV, David, but if you were the Armstrong group at whatever firm you came from, you're now the Armstrong group at Steward Partners.
Got it. Got it. And then, so you're taking on the compliance and some of the back office functionality. Um, the when you think about this overall, the trajectory that you have mapped out, is there any thinking that comes into play when we would prefer at Steward Partners to affiliate now with a firm that maybe has a good trust and estates division, or we want to affiliate with a firm that's, got some good alternatives investment chops. Are you starting to think that way in terms of the landscape, or is it just acquiring good partners that fit with the culture?
Yeah, I think it's the latter. I mean, to us, I think a lot of times companies struggle by thinking they can be the master of everything. And so we're not opposed to those items, but really, and I think as we've done M&A and we have a lot of folks that are looking to monetize but continue to stay on personally, right? They're opening up new doors for us in platform opportunities, technology opportunities, which we embrace those. But we like to stick with the true knitting of we're a wealth management firm, right? We're not preparing tax returns. We're not doing estate planning. We have tremendous resources around that. We have tremendous network from our advisors and their clients to handle all that. But I think there's a difference between that being an ancillary service and it being something that you're expecting to provide and carry the expertise and the risk of doing that.
Yeah, so you're not necessarily bringing those services in-house. You're leveraging your network of partners to do a lot
Correct.
of
Yep.
ancillary services that clients are maybe looking for.
Absolutely.
Um, you will, and we'll stick with M&A just for one more second before we move on. But the partnerships that you have with Sinosure and I think the Pritzker organization more recently, how does that work? How do you work with those investors? What are they looking at you for? And, you know, is there some sort of monetization event on the horizon that, I mean, none of these people are around forever. Everyone wants to, monetize something at some point. Is there some thing that they're looking at in terms of a timeline?
I mean, there's not. They are, they're both family offices, so that capital does not have a fixed duration on it. There's not a need to monetize an investment to put it into a next fund or what have you, or monetize that capital.
Mhm.
And look, there's nothing wrong with that. And there's tremendous private equity firms out there. We've met a lot of them. We know a lot of them. I think the difference was when we took that capital in, which was 2019 and 2021, respectively. We were very thoughtful around saying you want to have long dated capital at this point because it's one thing to say when we all think it makes sense, we should have a monetization event. It's another thing to say, hey, sorry, this is really bad timing. We have to cash out now. So we need you guys to get involved in a process and help us sell our shares. So there is no duration. They're terrific partners to us, and we would not be here today without their support. Four of them, two from each sit on our board of directors. We have a tremendous board of directors. So it really is something that we embrace the partnership. They are, combined minority shareholders. So they're very, very supportive, always happy to help us when we need their help. And listen, we've had tremendous success, which makes the board meetings pretty friendly for Hi and I.
Yeah, that's great. That's can't ask for more than that. Is there going to be any need for additional capital in the near future or on your roadmap?
Yeah, there always is, David. We think about that, every board meeting, it's a topic of conversation because look, we have continue to have extraordinary growth plans, right? So I think one of the things you see in firms that is not the norm is firms tend to flatten out, their growth rate starts decelerating. And I think really people hit a point of saturation. We don't have a point of saturation. So I'll offer out to you, David, I'm happy to come back on in a few years. We're going to be $1 billion revenue firm.
Mm,
And that means we need to bring in about $80 billion more in assets if you assume the same asset and revenue complexion we have today. In the last 20 years, that's probably only been done 3 or 4 times.
Hmm.
No one's ever done it without taking in capital at launch. We would be the first. So we have really ambitious growth goals. And I think to do that, at some point, you do need to think about additional capital, additional resources for that next really important leg of the journey.
Well, let's talk about resources then. How many uh, roughly employees at the so-called home office, I guess, of Steward Partners, not advisors out in the field, but
Yeah, the leadership team is over 100 folks. The partnership is over 550. And again, if you go back, you know, 5 years ago, it was a third of those numbers. So, but there's a terrific leadership team. We have our own broker dealer. We are an RIA, as you know. So we're running our own firm, right? And that is everything from technology and compliance, operations, platform and products, communications, technology, you name it. So we have all the bells and whistles there, and we're fortunate. We put together really a rock star leadership team to help us on this journey we're on.
so obviously the issues of a CEO of a firm your size differ a little bit from a leadership of a more mid-sized RIA firm. But talk to me a little bit about how you think about an individual firm's growth and what kind of uh, metrics or indicators they should be keeping an eye on to make those kind of decisions about when you add, say, a new sales assistant, or you add some back office around the brokerage, or you need to bring in the full-time marketing person. What should RAs be thinking about as they grow to kind of help them make those decisions?
Yeah, listen, I was fortunate, and my business partner, High Supporto, he ran a very significant corporate firm at Smith Barney and Morgan. I was always out in the field, so I was always an advisor, then went into branch management. So most of these firms are run on ratios, which is not a bad thing. So we always sort of backed into that, David, and said, this is the next bogey, and when we get to that bogey, we'll hire more people, and we'll add here, we'll add there. We're going to need more people in operations or risk or whatever the department is. It's going to need more help. I look at our head of HR joined us 6.5 years ago, and now there's 11 people in that department. So you have to be thoughtful around the checkpoints of the future and when you're going to need it. You can always hire too soon and not have enough bandwidth for them. So we've always had this sort of grow first and then add more people for the next wave of growth.
Hmm.
So we added 50 people to the management team in the last 3 years. We're obviously gearing up for the next leg of growth.
Yeah, that's a significant hiring spree. Are you having trouble finding talent, the same as the rest of the industry claims to be having trouble finding talent?
We're not. We're fortunate that, and one of our investors said this to me years ago, and I really couldn't get my head around it. Is he said, Jim, you're going to get to a point people are going to solicit you. So we get a ton of website inquiries. We actually have recruits and M&A people reaching out to us through our website and saying, I'd like to learn more about Steward. I'd like to sell my book to Steward. And I think that goes for management and talent as well. We're seeing a lot of those folks that we have a conversation with, and we might say, hey, there's not an opening today, but we'd love to keep you in mind for the future. And 4 or 5, 6 months later, there is a need, and we reach back out to them, and it goes from there. So we really have not had any struggles there. We're fortunate.
Yeah. At the same time, we talk about how the average age of the advisor is not necessarily getting any younger. I think maybe it's ticked down a couple of years in the 10 plus years I've been looking at the space. There still does not seem to be enough younger advisors coming into the industry. Any thoughts around that, or do we see it at that level with the introductory, junior advisors, new kids coming into the field?
Yeah, you're right. There's absolutely a real issue there that the industry has not solved for. And I think simultaneously, the major four firms that did most of the hiring historically have really shut down their training programs, right? They're either shut down or dramatically reduced. So that's actually making the problem worse. Ironically, in our legacy channel, the average advisor age is about 43. So we're a good 15 years
Hmm.
younger than the industry in the channel of folks who have monetized their practice and plan on being here for a while.
Hmm.
And that was important to us because that allows us to continue to buy more practices and have the team of talent to then turn those practices and those legacies over to be run. Overall at the firm, the average age is just around 50. So again, not young, but certainly not much younger than the industry average.
Yeah, much younger. That's by design, you say, or this is how? I mean, that's a pretty dramatic difference from the industry overall. Uh, Tease that out a little bit. Explain.
I think it's two really simple factors. One is it's much easier for someone who's in their late 40s to say, you know what? I got 15 or 20 years ahead of me. I'm sick of working at my firm. I want to go somewhere like Steward. I'm willing to make that move. I couldn't count the number of advisors that go, oh, Jim, I'm 60 years old. I'm too old for this. I can't move my book and the work. I'm just going to ride it out where I am. So I think the older advisors tend not to move, and the generation behind them is willing to move because they see a much longer path in front of them. And I think the second factor, which really is supportive of that, is in every industry survey, advisors under 40 are like 90% plus say, I would like to work at an independent firm of some sort. So that the push and the need for that is not shrinking at all. It's actually growing.
Yeah, right. And that's a different on-ramp than, what you probably had or people from a previous generation probably had in terms of the training programs that the wirehouses instituted, which were multi-year, usually training programs and pretty rigorous.
Right. Oh yeah. No, Smith Barney was a 6 month program before you even got your licensing and were ready to be, out there talking to the public.
Given that most RAs don't have that kind of same rigor, I think, in terms of training programs, are they missing something? Or I mean, was that a good period in terms of wealth management and going through those kinds of programs and do the RAs now, maybe less of an emphasis on the sales culture? Is that good for the folks that are coming into the industry, or do they need that kind of trial by fire?
I think it depends on what are they trying to achieve, right? If you have a great RIA firm and it's a few advisors that team together and that's your plan, and that's very different than saying I want to build a firm to 10 times its current size, right? So depending on your baseline of where you're starting from a goal perspective, it may be totally irrelevant, right? If you say, hey, we're three advisors in our 40s, we have a great team, we're going to build around us over time, right? They have no need for that maybe. I think what you're seeing though is without the hard sales training and going through that process, and people really don't appreciate how difficult it is. And this is the hardest industry in the world to build a successful practice from scratch. So I did it myself, and I tip my hat to those who have done it. What you're winding up with are people that are more client caretakers, right,
Mm.
than the hunter gatherer. So again, if the goal is to maintain what you have and you have a big enough clientele, right, not every RIA is going to be 10 or 15 or 20 billion, right? There's nothing wrong with running $1 billion, well-run, great client experience RIA. There's
Mhm.
obviously thousands of them out there.
Mhm. But for firms that do want to have that kind of more aggressive growth, same store growth, so to speak, getting the hunter-gatherer in the door is not a bad thing.
Absolutely. Yeah,
Uh,
listen, if you want to grow through M&A, right, you have to have capital, which as obvious as that sounds, most folks don't have the capital or as much as they need, right? Where is your story unique? And then what is your expertise in helping someone move their business, right? So if you're trying to attract someone from, you're at Fidelity or Schwab or wherever, and you're trying to attract a breakaway advisor, what expertise do you have to share with that advisor on moving a practice of their size? Because we've done it 150 times, right? There's a whole level of learning that goes in doing it that you have to have.
yeah, and and the just easing that transition is always important for advisors, right? The easier client onboarding. Talk a little bit about that. Your back office. I know you're multi-custodial. You
Yep.
have your own brokerage. Talk to me about how when you bring clients on board or advisors on board and the transition process.
Yeah, so I think it starts with getting to know someone, right? So we spend probably on average, 3 to 6 months in, a call and then a meeting and another meeting and then meet my team and so on and so on. They want to meet the rest of our team. So that there's a get to know you period that usually is months and months, could be sometimes it's a year. And then once someone's committed to join us, they go through about a 100-day process. It can be shorter if it needs to be, where we're going through all the pieces and parts and reviewing the assets and reviewing all their anything they have that we're worried about portability. So the whole thing is we're following all the rules around protocol, obviously. but we also want to help them make sure that there's no surprises for them or their clients or us. And then I think the big difference is where a lot of firms miss is we're then on site with them for months past them joining us, where there are representatives from the firm, there's administrative help, there's operational support. And I think firms spend a lot of time to get to yes and to get to the ribbon cutting, and then they're kind of on to the next thing. We're going to stay with those folks and make sure that they have a great transition because guess what? They're our best advocates for the next person. And over the history of the firm, almost half of our new advisors joining were referred by an existing advisor.
Hmm. So much the same way that advisors get referrals from clients, I suppose.
Exactly. And that tells
Oh,
me two things. Our advisors are happy here and they want to bring their friends, right? So that's the most powerful thing. And I tell every recruit I've ever spoken to, I say, listen, I'm overhead, I'm management. You probably believe every other word I'm saying. So please talk to any advisor at our firm, ask them what it's like to work here as a partner. And I have no worries about what you're going to hear.
well, that's great. Let's talk about organic growth in the industry overall, because I think we all know that it's when as equity markets just go up and up and up, it's pretty easy to tread water and claim you're a genius and the firm's growing like mad. But true organic growth here is pretty rare.
Yeah.
How do
Agree.
you how do your firms approach it?
Well, listen, I think what you have to do first, and again, it sounds like an obvious statement, but when you build a firm from scratch, you have the ability to choose who comes to your firm. So we tend to attract people that are very productive. So our average producer is north of $1 million. 2/3 of our advisors, CFP designated or higher. Obviously, a lot of that is planning based and advisory based. But these are also the top producers at their firms, or the top quintile. So the top quintile advisors always have a thirst for growth. And in our case, it's really just putting additional tools and resources and platform and technology in front of them. And we've seen advisor after advisor come here, build a multi-million-dollar book over 20-year career, which is incredible, and then double that in 4 or 5 years at Steward. So is that every advisor at the firm? No. There's plenty of advisors that say, hey, I run a great business. I'm happy. Things are good. My goal is to keep running my business and doing what I'm doing. So I think you have to focus on putting the tools and resources in front of the right advisors. Overall, we track this on a weekly basis. We're looking for true NNA, right? True net new assets.
Hmm.
And we back out recruits, right? If they've been here less than a year, we don't count that. Obviously, that's transition assets. We back out the markets. And we're literally looking at it if you have a $10 million client who takes out $1 million, you're net negative $1 million.
Hmm.
Right. So we track this down to the penny. And then that drives we probably have a mid-single digit overall organic growth, which is first quintile for the industry, but we'd like to see that number double where it is. And we think we can get there.
Yeah, I mean that's incredible for the industry. I mean, if, we're talking about net new asset growth, that's a high number because we know for most RIAs it is non-existent. Um, is it simply the fact that you're giving the advisors more tools and resources, like here's another marketing tech platform or here's a email automation platform, um, or is there some kind of thought in terms of marketing around how you help them kind of expand the funnel, find the prospects, et cetera?
It's all of the above. So we have some digital marketing tools we use. We have tremendous marketing team here at Steward. Our advisors are in the press and the media. They're on television very regularly. But I think it goes back to David, what we said earlier, which is, look, if you put the tools in the wrong hands, it doesn't much value there, right? So if you give me the basketball instead of Steph Curry, I'm not gonna score a 3-pointer for you. So I think it's that as well as putting those tools in the right hands where they're going to really run with them and embrace that. We have advisors doing podcasts and blogging and tweeting and doing all kinds of things they could never do where they were. So they find it's the ability to amplify what they've already done. But I would imagine for many other RIAs, like we talked about before, is if their team has become the caretakers and there's no sort of fighter pilot, hunter gatherer on that team, you're not going to have organic growth.
Yeah, so you need that hunter gatherer, and you need to give them the right tools to do it. And it used to be that advisors spent nothing on marketing at all. Uh, you know, now they do, obviously. Do you think industry wide, not just Steward Partners, but just in general in the industry, are advisors spending their assets in the right way on marketing, or are they doing enough of it, or too much of it, not doing it in the right way? 'Cause I feel like a lot of advisors are, there's the, okay, so blog on your site, start a social media channel,
Right.
ask for referrals, and it will all come around. Um, there's other things that advisors could be doing. What is the biggest organic growth driver for advisors that you've found that succeeds?
Listen, I think it's very simple. I used to be a training officer back in the day at Smith Barney. Listen, everything works, right? It's just sticking with it and continuing to do it, right? So the better advisors have a strategy around growth and they're executing on it and they're diligent about it and they stay on top of it. Right? No different than we're sitting here, we're talking about Happy New Year at the beginning of the call, right? It's the New Year's resolution. And I think the quitting day is any day now, right? The end of January, most people have given up on their resolution. Um, so the better advisors have a plan and they are just militant about sticking with it and they're disciplined about sticking with it. And it may not bear results immediately, but it definitely bears fruit if you stick with it.
Yeah, true, regardless of your size, small
Yeah,
or large advisor.
100%. Every type of marketing works. People give up after the first or second round is the problem.
That's fantastic. Well, Jim, thanks very much. We're at our 30-minute mark. I know that's our hook. So I really appreciate your time and congratulations on the success there. And we definitely look forward to seeing the next iterations.
Excellent. Well, thank you again for the opportunity.
And you've been listening to the RIA Edge podcast. Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.